All right, welcome to lesson 2. In this lesson, we're going to be talking about crypto fundamentals in blockchain knowledge. So in order to understand how cryptos work and to be able to trade them as efficiently as possible, we need to have some sort of background on cryptos and blockchain so that we can understand why they're even a thing, what cryptos are, and how to trade them effectively. So we have some background, but we're going to get more into the technical side of it and learning about blockchain and crypto fundamentals. So you'll learn everything you need to know about cryptocurrencies in order to evaluate, dominate, and trade them. You'll know exactly why they move, how they will likely move, and if they will perform how you want them to based on fundamental information, and that's what we're going to get into. Okay, so first thing we're going to learn about is market capitalization, also known as market cap. So the term market capitalization or market cap refers to the metric that measures the relative size of cryptocurrency. It is calculated by multiplying the current market price of a particular coin or token with the total number of coins in circulation. So if the price increases, the market cap will also increase, assuming the number of coins in circulation does not increase. So the way you're calculating market cap is by taking the total amount of coins in supply, price per coin times total number of coins in circulation equals market capitalization. While the market cap may offer some insight about the size and performance of the company or a cryptocurrency project, it is important to note that it is not the same as money inflow, so it does not represent how much money is in the market. This is a common misconception because the calculation of market cap is directly dependent on price, but in fact, a relatively small variation in price may affect the market cap significantly. So consider this example. If a few $1 million could potentially pump a cryptocurrency price from $10 to $15, which would cause the market cap to increase from 500 million to 750 million. However, this doesn't mean that there is an inflow of 250 million into the market. Actually, the amount of money needed to cause such an increase in price is dependent on volume and liquidity, which are distinct but related concepts. So DeFi is something that I also want to talk about just as fundamental information to understand about crypto. So DeFi or decentralized finance is an umbrella term for financial services or public blockchains, primarily Ethereum. With DeFi, you can do most things that banks do, earn interest, borrow, lend, buy insurance, trade derivatives, trade assets, and more, but it's faster and doesn't require paperwork or a third party. As well as with cryptos generally, DeFi is a global peer-to-peer system, meaning directly between two people, not routed through a centralized system, basically open to all. So put simply, DeFi is basically a non-centralized bank that issues cryptography or uses cryptography, blockchain, and smart contracts. So think of it as all the functions that a bank does, but using cryptocurrency so that there's way less loops to jump through and everything is a lot more efficient and a lot more quick. DeFi is taking the basic premise of Bitcoin, digital money, and expanding on it, creating an entire digital alternative to Wall Street without all the associate costs. Think of office towers, trading floors, banker salaries, etc. Okay, this is the potential to create more open, free, and fair financial markets that are accessible to anyone with internet connection. So this is definitely, in my opinion, the future of banking and finance in general, which is why I thoroughly believe in Ethereum. So now we're basically going to get into volume and average volume. If volume isn't something that you understand in trading, this is going to be very eye-opening for you because you're basically seeing a market participation with volume. So it's the amount of coin that has been traded in a certain period of time. For example, roughly 3.5 billion worth of Bitcoin has changed hands in the last day. So that's how much Bitcoin has been traded. That can be represented in volume increments depending on the increments that your chart is going by, but we'll get to that later in the course. So volume is useful for gauging the amount of market participation that is going on over a certain period of time. More volume means more people are trading, meaning that there are more people doing transactions and able to get you in and out of trades. So you can see where the larger moves are made on Bitcoin on the chart, the volume increases. So we can see right here, we have a spike in volume that is going over the average. This is where we got a major pull down on Bitcoin and then a major push up. We can see right here, we have major buy volume signaled by the blue candles showing us buy volume. And then if you look to the corresponding price action, we actually had a major increase in price action right where this volume increased. So that can kind of show you more positive, more buying pressure causes an increase in price. And then we have massive amount of selling right here. And if you look, you actually can't see on this chart, but that was a major move down on Bitcoin. We can see right here too, if we see this major sell-off point right here, we had a lot of selling pressure on this candle. So they showed us more selling participation. As a result, we saw the price drop significantly. So that's kind of how Bitcoin work. It changes colors to indicate sell volume or buy volume, but we can see the amount of participation that is going on based on the volume candles, which should in turn move the price action. So we can see participation as represented with price action. So average volume is the average amount of coin that has been traded in a certain period of time. This can tell you the overall popularity of the crypto being traded. So if a smaller crypto gets 30 million traded coins volume in one day based off of news, and then goes back to 200,000 per day volume for the rest of the time, it's not going to be a reliable trade vehicle all the time. And that is why we use average volume to determine if something is going to be a trade vehicle or not. I do this all the time in the stock world. I'll create a list of stocks that all have pretty good average volume to use as trade vehicles, because if you are constantly looking at stocks that have no volume whatsoever and no one's even interested in buying and selling them, getting in and out of the trade is going to be such an issue. And that is exactly why we're going to talk about liquidity now. Basically, in terms of cryptocurrency, liquidity is the ability of a coin to be easily converted into cash or other coins. Liquidity is important for all tradable assets, including cryptocurrencies. Low liquidity levels mean that the market volatility is present, causing spikes in cryptocurrency prices. So for example, imagine you want to sell someone something at a farmer's market. Farmer's market 1 has 10 people all looking to buy corn at all different prices. Farmer's market 2 has 1,000 people all looking to buy corn all at different prices. Same thing, but we have 1,000 people now. So if you want to sell corn for $2 in the farmer's market, but there are only 10 people to sell to, you might not be able to sell the corn that quickly. You might not be able to sell it for exactly the price you want instantly. If you want to sell the corn for $2 in the farmer's market 2, where there are 1,000 people to sell to, the chances of you selling that corn for the price you want and selling it quickly is a lot higher. Thus, farmer's market 2 has more liquidity than farmer's market 1. So essentially, if you have high liquidity, that means usually you have high trading volume, which means you have a lot of participation and a lot of people looking to get in and out of trades at all different sorts of prices, meaning that you have a good chance of being able to get exactly in and exactly out wherever you want. And that's why liquidity is important. That's why it goes hand in hand with volume. You need to have good liquidity in order to have a good trade vehicle. And in order to have good liquidity, you need market participation, which is represented by volume. Okay, so usually the more volume in a crypto means more people want to buy and sell at a wide variety of prices, meaning that the market is liquid and you can buy and sell basically at any price you want without having to worry about someone being on the opposite side of the trade. Next thing we're going to talk about is bid and ask. So buyers and sellers, this is going to be the basics, and then we're going to be looking at it a little bit more into detail a little bit later on into the course. But there are always two sides on a trade and a transaction, a buyer and a seller. So there has to be someone willing to buy from a seller and a seller willing to sell it for it to happen. So for example, let's say that coin XYZ is $10. In order to have the price increase to 11, you have to have someone on the opposite side of the trade wanting to buy it for 11 in order for the seller to sell it for that price in order for it to increase the price of the coin. Okay, so bid and ask spread is the difference between the lowest seller offer and the highest buyer offer, called the spread. Okay, so if a buyer is willing to buy at $1.90 and the seller is willing to sell at $2, meaning there's a 10-cent spread. So if you see the spread, if you see us talking about that term, which we often will when we're talking about liquidity, this is the difference between the buyer and the seller. And if you're looking to buy something, you need to buy from the seller, but the next willing person to buy it for $1.90, if your seller is at $2, this means that you'll immediately lose 10 cents multiplied by the original amount you bought. So for example, let's say that you're willing to buy this cryptocurrency at $1.90, right? So obviously when you buy, you want it to appreciate in value so that that you make money. So the first seller who already owns the coin is only willing to sell that coin for $2, right? So immediately, if you want to get in, you have to buy from a seller, which is going to be the ask. So if we talk about bid and ask, the ask is going to be sellers and bids are going to be buyers. So if you want to buy in, you can only buy in immediately from the sellers on the ask. And then as soon as you turn around and go to sell, you're only going to be able to sell to people on the bid, which is always going to be lower than the ask. So you're automatically losing the spread as soon as you enter a position. So if the spread is huge, that's something you have to consider when you're dealing with volume, liquidity, and the spread, taking trades on certain asset classes. So if you want to immediately buy this coin, you can buy from the seller at $2, but the next willing person to buy from you is at $1.90, meaning that you're going to lose the spread. I think I just covered that twice, but it's very important. So here's a visual representation of the bid and ask. This is going to be something that I get to a little bit more into the course when we start talking about how to actually get into trades. So I think I'm actually going to cover this a little bit later. So this is a more advanced explanation of the bid and the ask. So the bid, buyers, is the price people are trying to buy at right now. So you can see as we get closer and closer to the current price, the amount of people trying to make those transactions are going down and down. So we have an accumulation of orders all in different price ranges, and then as we get closer and closer to the exact amount, that's where the orders start to decrease, and that's where we kind of see them meeting, and that's where the bid and the ask sort of fights. And this is a visual representation of that. So you can watch it happen in real time and see where the buyers and sellers are actually sitting. As the order gets closer to the current price, there are less and less orders on the opposite side of the trade, so there's less availability. All right, now we're going to talk about something called ICOs. So if you follow stocks at all or know much about stocks, you probably know something called an IPO, which is an initial public offering. So with cryptos, basically it's an initial coin offering, but basically stands for the first time that the public is able to invest their money into the cryptocurrency. So this is where cryptocurrencies offer the coin, put them on an exchange, and register them as a investable security. And actually, if you know about XRP's situation, XRP never had an ICO, which is why the SEC is now coming after them, saying that they're a non-registered security and that people are making money off of it and that it's fraud. ICOs are basically offering it to the people to invest and putting it on an exchange as a registered security.